All right, guys. So this is perhaps the most important video in December and maybe even 2025. The Federal Reserve has cut interest rates, and this sets up a very dangerous future for 2026 and beyond. Now, Jerome Powell has lost against Trump, and Fed independence is now under threat. Despite the tariff war and despite rising inflation in the United States, rates have been cut. Now, this is even before Trump's man, Kevin Hassett, enters the Fed in 2026. We can expect more Fed promises to evaporate. Now we're going to enter a world where three things, they are baked into the cake: the dollar's demise, the future is now compromised. The U.S. debt crisis is not going to stop. And the massive inequality we see today is about to get worse. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September. And excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. So Powell spelled out the disaster. Trump's tariffs are causing the rise in inflation. He calls it a one-time increase to prices, but that isn't really the case. It will still take a few more months before the increases are truly priced in. 2026 is when we are going to see the true face of inflation, but yet rates for December has been slashed. Now, this cut is extremely bizarre for many reasons. Firstly, most rate cuts precede a recession when the economy was already on shaky ground. Now, in 2008, it happened during the housing crisis, but the Fed today is cutting into strong GDP data. US Q2 GDP hit 3.8%. That itself shows us that the card will be inflationary. We have officially gone under the 4% mark, with the Fed funds hitting 3.5% at a lower bound. Powell, under the pressure of Trump, is trying to keep the gravy train going. If inflation was really a crisis, they wouldn't cut at all. Let's remember, power will be gone in May 2026. He will be powerless. Trump will be in control of the Fed through Kevin Hassett. Now, the cut itself is highly divided, with many members of the Fed wanting to halt rates where they are. Obviously, they know the dangers of inflation. The Fed is also flying blind without any proper macro data from the government shutdown. So what we have is a panic card to prevent an economic implosion. But of course, the relief valve will be inflation. If we look at the Fed's December dot plot, we have zero certainty at all. 2025 was messy enough, a very divided decision. But in 2026, the Fed can't decide on whether to hike, stay where they are, or to cut even further. How has signal additional cut next year? But that's it. For decades, the Fed's neutral interest rate has been around 2.5%. But how can they risk cutting the Fed funds when everything is up in the air? Only 3 members were bold enough to demand rates to go below 3%. And how can they be sure? U.S. deficits are exploding, and Bassan keeps issuing a tsunami of bonds. The trade war with China is only wrapping up, which means more spending on the horizon. This could result in stickier inflation. If 2026 has 3 cuts or more, the Fed will have zero room left to maneuver should a recession happen. They will have to cut rates to negative levels for any effect. If that isn't insane enough, the Fed has committed itself to printing money, and this is why markets are rising. Powell has signaled a balance sheet increase. Now, the Fed will be buying $40 billion in U.S. Treasury bills starting on December the 12th. At the pace of this buying will remain elevated for the next few months in April. In other words, the U.S. Treasury is going broke and the banks need liquidity. They are calling it reserve management, but it's just a bailout, plain and simple. This won't stop at just $40 billion. This move is highly inflationary, especially for asset prices. The Fed has become the buyer of last resort, and this purchase is all about supporting the markets. That's why the S&P is up. That's why gold is also up. The Fed is blasting dollars into the system and reflating their balance sheet. It's not just a halt to QT, this is QE, quantitative easing. Now, since 2020, the Fed has officially created more than $2.5 trillion that is still in the system. That is additional money units that were conjured into existence from nothing. Powell was supposed to reduce this amount back to the pre-pandemic levels, but that would most definitely collapse the U.S. economy today. So the only move left is to inflate the bubble and give liquidity support. But notice the type of buying happening. The Fed is buying T-bills and not long-term bonds, is a signal that the new U.S. funding strategy is all short-term. A lot of money will be rolled over and over and over again to keep the shell game going. Now the debasement trade is back in action. Gold is on the brink of hitting 4,300 again. Even the price of silver is reaching new highs. Everyone is scrambling to buy assets today. Silver just hit $63 for the first time in history. It's above the previous inflation-adjusted high. Global liquidity is rushing into this tiny market. Everyone knows what is coming down the road. Monetary debasement is coming by launching stealth QE. The Fed is increasing the money supply, and all assets that were underbid are getting bought now. Everyone is buying. People on Wall Street, retail buyers, they're all scrambling towards real money, which is obviously gold and silver. So, let's be clear. The Fed has fired up the money printing machine. Even if there's only one rate cut next year or none, the U.S. dollar will still be under enormous pressure. There are two trends we need to pay attention to. And a big shout out to our sponsor today, Indigo Precious Metals. When it comes to buying gold and silver, I trust Indigo Precious Metals in Singapore. They have made investing in precious metals safe, fast, easy, and simple for both small and large-scale buying. I've been stacking gold for over a decade now, and I've learned two things when buying. You want to buy authentic gold bullion, and you want to buy it at the lowest premium possible to stretch your dollars even further. And I'm glad to say I found both of this at Indigo Precious Metals. Indigo Precious Metals is a leading retailer in Singapore. They specialize in physical gold, silver, and platinum. They are my one-stop shop when it comes to buying bullion. Their prices are sharp, and they have the best brands on sale, and I can test the gold on the spot. So if you're looking to make your first gold purchase, Indigo Precious Metals is the best place to start. Whether it's 1 ounce or 1 kilo, this is the reputable dealer you are looking for. So take action today. Click on the link below and enjoy a discount on your first purchase with the code SHAFU. Start your gold stacking journey today. Firstly, the U.S. Treasury is only going to borrow more money next year. The amount will increase by at least $150 billion next year. There's no way for Besen to cut spending down. The U.S. wants to rebuild supply chains. They want to reshaw industries, not forgetting expanding the U.S. military while fighting the AI war and semiconductor war with China. They're just juggling too much. All this will cause an incredible amount of money. With the Fed buying U.S. bills, Besen is getting money directly from Jerome Powell. When the Fed starts buying $40 billion in short-term debt is as good as blasting money into the economy. The money recycles faster, the interest gets paid faster, and the entire amount gets rolled over in just a matter of months. So now the money supply grows even faster. It's actually worse than issuing a 10 or 20-year bond for Besen. This gives him more incentive to issue more T-bills and shift even more funding to the short end of the curve. You have a willing buyer who can create money out from thin air, and that is the Federal Reserve. Since 2022, the Treasury has been borrowing more and more money from T-bills. He has gone from 15% of total issuance to over 22%. And this was when rates were rising. Now that Powell has cut Fed funds by 25 basis points, Besen would most definitely issue more bonds here. This is very inflationary and dangerous for the U.S. money supply. Now that the Fed has stepped in to buy the bonds, if there's any crisis at all, they can accelerate the buying. It might be $40 billion today, but if a recession or crunch happens, it could be $400 billion tomorrow. This next part is important. The U.S. banking system is running out of money, and it's thanks to Treasury spending. That's why the Fed had to support the system. Trump is simply borrowing too much money. We'll explain it simply. The Treasury General account, the green line, has been rising like crazy over the past few months. It's sitting at nearly $2 trillion. That's how much money that a government has sucked out of the real economy. Meanwhile, bank balances at the Fed, which is the blue line, has crashed to almost zero, which means they don't have any reserves left. If there is a sudden money squeeze or recession, there's simply no money left to deploy. The entire system could freeze up. That's why Powell had to do the unthinkable. He had to step in and pump money into the economy. If we listen to Scott Bessent's speech, he probably knows the Fed will continue supporting the economy. How and the next Fed chair will step in to buy U.S. bonds. There isn't any need for foreigners to step up. Even U.S. investors can go take a nap because the buyer of last resort has woken up. Money printing is back. The bond market had its best year since 2020. And if I have anything to say about it, as your nation's top bond salesman, bonds will have another strong year in 2026 as we fight to bring Treasury borrowing costs down. Yes, the bond market will get supported. Maybe yields won't spike to the moon tomorrow, but it's still printed money. It's magical digits getting typed into existence. There's no stopping this debt train. The $38 trillion debt we have will balloon out of control. Investors will lose confidence, and private buying of U.S. bonds is going to drop. The current interest on the debt just broke $1.2 trillion annually. That's $1 trillion with a capital T. Long-term yields are not dropping. In fact, they are going up. So higher interest payments are coming. In 2026, the Fed might cut rates once or not at all. Once again, higher interest payments are coming. How will the U.S. government pay bondholders their $1.2 trillion back? They will have to issue more bonds to pay for it, as the Oruro-Barrows effect. The snake is eating itself. So don't buy the idea that lowering rates actually helps the national debt. It doesn't, because the debt burden is just too big. It's well past critical mass at this point. The Fed cut is nothing to cheer about. Yes, asset prices are going up, and if you're in a game, well done. But for those without, the cost of everything is going to fly up. The most immediate casualty of the red cards is the U.S. dollar itself. Now, when a country's currency falls, the frontline victims are consumers. As a result of the rate cards, the dollar index is back down under 99. The U.S. still imports 15 to 20% of everything. So now prices are going to rise from a weaker currency. This means the poorest people will have to pay more for food and products. They have no assets to offset the rising cost of living. So for Main Street, the red cards are more painful than anything else. Now, what does this mean for us? Well, it depends. If you have money, then asset prices will likely rip higher. Doesn't matter if it's stocks or gold. But if you unflushed with cash, it's time to be defensive because inflation is coming back with a vengeance. This is just a calm before the storm because 2026 could get even worse. Next year, Kevin Hassett would likely be the Fed chair. He is the front runner to be the next leader of the Federal Reserve. And this poses a lot of problems. The perception of Fed independence is about to get eroded. Trump is going to get a cut he wants. Powell might be saying one cut in 2026, but is that really going to be the case? We might get multiple cuts next year for all we know. This could create even more of an inflation crisis. So yes, asset prices are rising today. Consumer prices are also going up today. However, we have no idea what tomorrow might bring. We cannot assume that rate cuts are done in 2028. Trump could force the Federal Reserve to cut rates. It's not impossible. In fact, it's very likely. But let me know what you think. Why is the Fed suddenly printing money again? And are we back in quantitative easing once again? Let me know in the comments below. Stay safe. Be sure to smash that like button and subscribe as we navigate through this inflationary times.